Welcome back, everyone. I'm Clinton Smith, and this is our 2 Cents Live. I'm the CEO of GCS, and I'm also here with the president of GCS and our resident financial advisor, Galen Bargerstock. Galen, how are you today?
Good, Clint. How are you today?
Another wonderful day.
Sun's shining again.
Yep, every day.
Every day.
So, Galen, today we're going to be talking about life insurance. For all of you guys at home, I know life insurance can be a very daunting, very scary subject. It's a kind of thing where one word can literally change the meaning of the entire paragraph, right? Yeah. Where one word can just change the whole entire meaning. You don't, there's so many different parts to life insurance. We're going to try to break it down for you guys today in about 30 minutes and give you as much information as you can. But honestly, if this is confusing for you and we've lost you at some point, I'm going to try to get you back on track. But you can always give us a call, 888-391-3465, and we can give you a whole review and help you understand your life insurance and anything that you have questions about regarding life insurance. So let's start it out. What are the different types of life insurance?
So there's about 3 main types of life insurance, that I would say. You have whole life, you have term, and then you have a UL, and it's either an IUL or
Hold
a
on,
VUL.
back it up.
Yep.
Let's just tell us, what does whole mean?
Whole life. Okay. So what a whole life policy is it's going to follow you for your whole life. So it is a permanent grade policy, and what's going to happen is you're going to buy that, and the price is going to stay exactly the same for your entire life. It's a whole life policy.
So it's referring to your life as it being whole for the rest of it.
Correct, and it's going to build cash value, and the cash value, you can do withdrawals before you're 59 and a half. You do policy loans off of it. So permanent policies, you can be your own bank, but the universal policies are more for that.
So I'm sure we're going to get into that in more detail later. Let's go over the other types. How about term?
Okay. So term life insurance is a term, whether it is a 10-year, a 20-year, or a 30-year, being that in 10 years, it's the same price for 10 years, and then after that 10 years, it termed out, and now you no longer have coverage. Same for 20-year, it'll last same price for 20 years, and then the coverage will expire, and you have to renew, and here's the important part to know. You have to renew that term policy if you want to renew it and keep it at a different price point, and you're 20 years older, so it's going to be more expensive.
Yeah. Now, in the end, are term policies typically, I know the answer to this, but let's have you tell everyone anyways. Right. Term policies are pretty much cheaper when you're younger.
Yes.
How about whole life? How does it compare to term when you're younger?
The first thing that I'm going to say is that all life insurance policies are cheaper when you're younger. Okay. Because when you're younger, that's going to be the cheapest point that you can buy it, purchase it, because it's all age-based.
So like for me, they would all still be cheaper, but for you, they'd be more expensive. That's what you're saying?
Only by 2 years. So yes, a little bit.
4 years difference here,
2.5.
everyone.
2.5.
It depends on how you count.
Yeah.
So there's term, we talked about whole policies, and now let's give out some confusing acronyms.
Okay. Confusing acronyms, IUL, VUL, GUL.
So what do those, let's start with IUL.
So let me just start with UL, Universal Life. Universal Life is a permanent policy, and it's going to build cash value in a sub-account. And if you call it an IUL, it's going to be more on a fixed platform where you're riding indexes inside of the policy, taking gains, and having a little bit of safety because it's going to be on a safer platform. Where a VUL, a variable universal life, you could make more money inside of the sub-account, but there's more risk involved inside of that. So you just have to be aware of the risk involved if you want a VUL.
What's the G and GUL stand for?
The G in GUL is my favorite. A GUL is a guaranteed universal life policy that is going to lock in that price and guarantee it to a certain age, whether that is 90, 105, 110, but it's going to guarantee the price lock and that insurance will be there no matter what. And the G is important to me in that.
All right, so guys, what I'm gathering here is the first letter changes. The last two are UL, standing for Universal Life. And the first one is what changes it. So we have index that rides off the index.
Correct.
Variable that can be a variable rate.
Correct.
Throughout the term of the policy.
Yes.
Now, are these IULs, VULs, and GULs, are those term or are they whole?
They are different, but they are permanent. Okay. So it is a permanent life insurance where it is going to build cash value. And inside of that cash value, it could become a financial product in the future where you could withdraw money from that before you're 59 and a half, so you don't have to tap into your investments with a penalty, in some scenarios.
So are those the ones with the acronym, the 3 acronyms, are those, I'm sorry, not guaranteed, but you just said something about,
The GUL?
are they more for building up money inside of the policy for you to take?
In ways, yeah. This is just how I would, describe it. The IULs, VULs, ULs in general, and the whole life are permanent. It's like you own your house. And a term is like you're renting your house. So it's like you're renting versus owning.
Yeah.
And if people like to rent, that's fine. But owning seems to bring a better value.
Yeah.
Yeah.
Well, it's a way to build wealth.
Build wealth, correct.
So I know that those are a lot of confusing things, guys. If you, again, are at any point in this conversation confused about life insurance or wonder what you have, you can always give us a call at 888-391-3465 and book an appointment, and we will help you go over it. But real quickly, tell me, what does a group policy mean? Because I know that's another term, and a lot of people have group life insurance policies. What does that mean?
So group policy in general is going to be for a group, whether that's an employer group, churches can have group policies, but it is a group of individuals that are, it doesn't matter what your health condition is, it's the same price based on age, and you can go into that and have that for your employees. Most of them are going to go up in price as you age, but you're going to get guaranteed insurability even if you had a heart attack the day before. Most cases.
So in that case, I'm assuming that's why group policies are sometimes not the most cost effective.
They are not cost effective.
It's not something we would really recommend for anyone that is super healthy. If you run 20 miles a week, you bike, you hike, you trail, I don't know, what are some other active things that you could do?
To me, it's just about control.
Yeah.
It's about, grabbing everything and knowing what you have. Group policies, dirt cheap when you're younger. So I'm not going to say that group policies are bad. I don't think that anything, product-wise is bad. Everything serves a place and it's there for a reason. But at the end of the day, you need to watch what goes on with group policies because there is a certain age range, I would say 50 to 55, where outside companies are going to beat them, if you're healthy.
Yeah.
Yeah.
So guys, remember, you can give us a call at 888-391-3465 for any questions about life insurance, and we'll be back in just a few seconds.
When was the last time you saw your financial professional? Are you getting the most out of the strategy that was created for you? Although you've done a great job finding someone to help plan for your future, are you 100% sure that you were given the right strategy? We can help answer these questions and more with a complimentary second opinion evaluation. We will take a look at what you have in place and then help determine if you're well positioned to get the most out of your future retirement income. In the event that it is not, we can help by making suggestions and showing you how to get on the right path. You wouldn't get just one opinion when it comes to a major health decision, so why would you treat your most important financial decision with such disregard? Call today for your no-cost, no-obligation second opinion evaluation to see if you're getting the most out of your retirement income plan.
Preparing families for retirement, GCES.
Guys, welcome back to Our Two Cents. I'm your host, Clinton Smith. I'm also the CEO of GCES, and I'm also here with Galen, the president of GCES, and also our resident financial advisor today. So Galen, we've been talking about life insurance.
Yeah.
You've broken it down. You've given us several acronyms to try to remember.
Yeah.
You've talked about the different types of life insurance and the difference between a group policy and an individual policy. Let's get into it a little bit deeper.
Okay.
If someone's sitting at home, how can they figure out what type of life insurance they have?
Statements. If most people are going to have an HR department, so contact your HR department, ask them what type of life insurance you have. A lot of people forget.
That's if you get it through your employer.
If
though.
you get it through your employer,
Yeah.
correct. Yeah.
If you got it through the guy who sells you your home and auto, you should call him, not your employer.
Correct. Yeah.
Or if you don't remember, call us, 888-391-3465.
Yeah. I mean, it's very common for people to not know what they have. I've seen many people bring paperwork out to an appointment and, they show me this and they're like, what is this? And I'm like, well, that is a $3,000 life insurance from your credit union. So a lot of times people don't know what they have. So we need to put it all in one place.
Yeah. So guys, organize your files and then give us a call.
Yeah.
Yeah. And whenever we sit down, I know that you talk about doing a full financial review, that whenever you go over stuff with people, life insurance needs to be a part of that.
Yeah, no. I mean, at the end of the day, nobody wants to think this, but we're all going to die. And it's not doom and gloom. It's just the fact of life. So life insurance has to be inside of your financial plan because it's inevitable that you are going to pass away.
Yeah.
Yeah.
I mean, life insurance is a huge part of what we do. We've worked with people to help understand it. If you're in an employer-sponsored plan, which we come into a lot of times, how does that end up correlating into retirement? Are they able to carry that into retirement as well?
And most of the time you can carry it into retirement. The problem is the price associated with the group policy. Group policies tend to double in price every 5 years. And when I say group policies, I also, whenever you're finding out from, the person that you bought your other life insurance from, find out if it has step increases as well. That's good to know because there's some insurance companies that sell them that go up every 5 years. But yeah, you can port them. It's just the price becomes so obscene, and that's why you want to do as soon as possible address the life insurance. The younger, the better.
Now, I know that we have run into clients where Galen or one of our agents will go out and sit down with the client, and they have like 15 life insurance policies. They literally bought life insurance policies from everyone that ever told them about one.
Everybody that they ever talked to.
Yes.
Yes, buyers.
And in that situation, what do you think is the correct thing to do if someone has way too much life insurance?
Well, the first thing I have to do is address your health if that is what's going on, because you really need to consolidate some stuff and figure out what your actual need is versus all these little policies, because that little policy that I said from the credit union, that might go away as soon as you leave that credit union. So the inner workings of everything, if you have too much, it's called it being insurance poor, because you have way too much money if you're going to pass away that you're spending so much, and it could be used investment-wise or something else. Yeah.
Which really brings us to our next point. How does life insurance, how does that work into your retirement plan when you're planning retirement?
I would say not just, like everybody passes away, but not just that, survivor benefit. So a survivor benefit, if you are lucky enough to have a pension, and if you pass away, you're going to leave a portion of that to your spouse, there's a cost involved with that, and you have to pay for that, where you could do life insurance instead. There's a whole scenario of what needs to happen to calculate if that makes sense or not, though.
So let's just give an example of someone that is going to be retired. I want to break that down a little bit more, because if you have a pension, this is specifically for you. And inside your pension, you have a thing called survivor benefits, where if you pass away, you'll get, what number do you want to use? How much less is it usually?
50%. Make it easy, 50%.
So you lose 50%. Let's say you make $1,000 a week or a month. A month from your pension, $1,000 a month from your pension. You pass away, you then give to your spouse $500 a month.
Correct.
Okay. So let's say, what happens if you lived for 10 years?
Who's passing away? Is anybody passing away, or both people alive for 10 years?
So no, the person with the pension passes away.
Correct. After 10 years.
Yes.
Yep. So they would have paid in a premium to have that survivor benefit.
$500 a month, right?
To receive half, 50%. So
Yeah.
they're receiving half, the $500 a month. But calculation-wise, that's about $100 a month in the scenario that you're talking about. So that person, yes, they are providing their spouse that benefit 10 years later, but they had to pay $100 a month for 10 years in order to leave that $500.
So $12,000 is, I can do the math. I don't know if we can get like a number on the screen. I don't have a calculator with me. Guys, I do math on my fingers and my toes and a calculator. So it would have been $12,000, because it's $100 a month that they pay to have it. So they normally, if they didn't get that benefit, they would have been paying $1,100 a month, but they're getting $1,000 a month instead. So they're paying $100 a month to have that benefit.
Correct.
To pass on $500 a month later.
Correct.
So after 10 years, it's going to be a total of $12,000 that they've spent to have that, right?
Yeah, and the spouse is getting $500 a month. So if they've spent $12,000 and now they're receiving $500, that spouse has to survive for a certain number of years in order to make money on the deal.
To make up the $12,000.
To make up that difference, yeah. So if the person in your scenario, that what you're telling me, if that person lives for 10 years and then passes away and that spouse receives $500 a month, but then that spouse passes away 6 months later, they spent more money for a survivor benefit than they did for that spouse.
So let's even do the math on that back end. We have $12,000 to make up, right?
Yep. Yeah.
So if they're only making $500 a month, that would end up being 10, 12 a year?
Yeah, so you just take the 500 and divide it by the 12,000, so 6,000.
Okay, so how long would they have to live to actually make it worth it?
Roughly 6 years. Not
Okay.
6 years, 4 years.
Okay. And if the spouse passes away, but first,
Yeah.
none of that passes on to your
Correct. It doesn't trickle down to the children, and that's where life insurance is going to be your bigger moneymaker, because if you're putting that same $100 into a permanent life insurance policy, and you pass away, your spouse gets the big payout, which is tax-free.
Yeah.
And then they can do whatever they want. But if the spouse passes away during that, you're not going to have to worry about, it leaving the household like the survivor benefit would. You just retitle the beneficiary and keep a legacy in the household.
What do you mean that it would pass on tax-free?
Life insurance, when a person passes away, it does go tax-free to the beneficiary.
I'm sorry, can you repeat that, but in different
Tax-free.
words? Tax-free. So guys, if you didn't catch that part, I knew it already. I just wanted him to say it because he sounds better when he says it.
Right.
But if you pass away and you have a life insurance policy, that money passes on tax-free to your beneficiaries. That's why it's not always the best idea to choose survivor benefits over a life insurance policy, because no one has a crystal ball. No one knows who's going to die first. We just know that it's going to happen.
Correct. Yeah.
Yeah.
Everybody's going to pass away, and whenever you have the IRS as a beneficiary, that would be on your investments.
Yeah.
The IRS is going to get their cut, but on life insurance, the IRS is not a beneficiary.
Yeah.
It is just your family.
Not only that, how about maxing out contributions to the year with life insurance, where people can max out their yearly contributions if they've made too much money in the year, or they've already maxed out the contributions, they can put the money into an IUL.
You're talking about funding an IUL and putting more money inside of that. Yes. So, if in your financial products you are maxing out annually what you're allowed to contribute with the matching money and your money, you can put into an insurance policy, an IUL or a VUL, and build cash value inside of that when you can take that out before 59.5 with tax-free income. So there is a wealth strategy inside of life insurance. Also, income earners that might be earning too much money to go into a Roth IRA, you can also fuel that into life insurance products to have for retirement.
It's a lot of life insurance talk today, guys. Remember, you can always give us a call, 888-391-3465, to find out more about life insurance. We can answer your questions, and we'll be back in just a few minutes.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter, the one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Preparing families for retirement. GCES.
Guys, welcome back. We've been having tons of fun talking about life insurance today with Galen Bargerstock. Galen, life insurance is confusing.
It's very confusing.
There's a ton of stuff to know.
Yeah. I was lucky enough at the beginning of my career to learn life insurance, and it kind of gave me my foundation of everything that I can talk about. So life insurance is very important to me, and it's also how I began.
Yeah.
So I do know a lot about the life insurance aspect.
Well, good. I'm sure you have to, because I'm sure people have tons of questions.
Yeah.
We talked about people paying too much for life insurance earlier. I want to touch a little bit more on that. When someone's paying too much for life insurance, how can they tell? And I don't mean too much. Maybe they have too many policies. Maybe they have tons of policies that they don't need. Yeah. How can someone tell if they're just too heavy on life insurance?
Well, first, just human nature. If you have that gut feeling that you might be paying a little bit too much for your policies, then you probably are, because you're already in your head think it's too much. So you might be oversold policies to go into. What I would also say is, a lot of these group policies that are coming out of paychecks, if you're noticing your paycheck, well, what is this line where this is now $70 biweekly, and now it's $100 biweekly, and you're questioning what that line means, because a lot of people don't know what the life insurance value is or the cost associated with it.
Yeah.
So,
that goes back to what we talked about earlier with term policies.
Yeah.
And I know we work with tons of federal employees, we work with tons of postal employees, and I cannot tell you how many times I have talked to postal employees where we're going over their pay stub and they have no idea not only what line their life insurance deduction comes out on, they don't have any idea what kind of coverage they're paying for, and they don't even know that they've been paying it for so many years. I actually remember when we first got in the business, we met some people at a seminar, and there was one guy in the meeting. This was a federal employee seminar, and there was one guy that was sitting in the back of the room. The entire time he was sitting there with his retirement book, waiting for us to help him fill it out. And Galen went over, but Galen wouldn't just fill out his retirement book. He actually went through and did a review for him, just like we should. It's the right thing to do. And the guy was paying $329 every paycheck bi-weekly for a term policy that was going to be going away as soon as he retired.
Yeah. And he didn't have any family.
And
he's paying all this money, and he had nobody to leave that money to as well. I mean, the whole scenario.
He didn't even know that he was paying it. We did the math back then. I want to say it was over $16,000 a year, and we know that he was 63. And they term every 5 years. Yeah. So he paid $16,000 3 years in a row.
Yeah.
I won't even try to do the math on that like I tried to do math
I think
earlier.
it was a little bit, 16 is a little rich on that one, but yeah, you're not wrong. I mean, he was paying an obscene dollar amount monthly or annually to have that policy with nobody to give it to.
Yeah.
And he didn't even know.
And once he retired, it was canceled anyways. It goes away.
Yeah. The problem and the reason why it happens is when people get hired on somewhere, it's kind of a shuffling process. You're trying to get that person to move fast so they can, learn the job and then start working.
Yeah.
So people just elect stuff, and they don't know what they're actually electing, and then over time they just forget about it.
Yeah. And a lot of times I think some people might pay a little bit more for life insurance, and instead they can put that money into their investments and into their retirement.
Yes, 100% correct. So most of the time what I see is that not only is a person paying in group policies, not only are they paying too much money for that policy, if they were in an appropriate policy for them, they would save $100 a month, and then that $100 a month could have got socked away into the investments, and then they could have been putting more money into their 401k to create wealth.
Yeah. And I know we've talked to tons of people with life insurance, putting money into the retirement plan versus life insurance. When we sit down with people and meet with people at GCES, we understand that life insurance is important. You should have it. But also, if you're planning for retirement, it's more important, especially for people that get matching money through their employers, to be getting that matching money from your employer before you start paying for life insurance. And that's something we've kind of stood by.
It's like a standard practice for me. I will not sell somebody a life insurance policy if they could be putting money into their 401k. So I examine, holistically the entire household approach, look at everything, and if they're paying, say, $150 biweekly for life insurance, and they're not putting any money into their 401k, I will not put them into a life insurance policy. I would want them to do that first, and then I'm going to address the life insurance, but you need that matching money in the investments.
Yeah.
It's just, why pay an insurance company when you can pay yourself?
And get free money from it. It's really about getting
It's
that
about
free
the
matching
free
money.
The free matching money, correct.
Great, guy. So I know we've talked about differences in life insurance. Let's talk about someone that's in their 30s and 40s versus someone that's in their 50s and 60s. Just what's a few of the things that somebody's in their 30s and 40s should be looking for rather than somebody that's in 50s and 60s?
Well, it's stages in life, and it's how everything rolls along. So 30s and 40s, children are still young if you have children. You have more bills. You still have a mortgage. Expenses are high. So a larger term policy might be more appropriate, 30s to 40s. And then 50s to 60s, you might be more into the permanent policy aspect of it, or you should at least address it because the house might be paid off. Children are out on their own. They have jobs now. There's not as big of a need for you to have that policy because you're more well established in life. But if you're 30 and you can afford to go into that permanent policy, that's a really good time to do it because that's as young as you're going to be when you could address it. But it all comes down to budgeting and what you can afford, what you need to do for your family, because life insurance is to provide if you pass.
Yeah. And for everyone that's watching at home, guys, you're not going to plan your retirement from watching our show. No. You have to give a call to the number on the screen, 888-391-3465. We can sit down and go over all this stuff. This show is for information and to help you guys out. But honestly, that is so complex. There are so many differences that we would feel better that you called us rather than trying to do it yourself. Now, very quickly, Galen, we don't have much time left.
Yeah.
I just want to know, what are some bells and whistles of life insurance that you can add on to a life insurance policy that people not know that you have?
Yeah, so you can add in riders, to a life insurance policy, such as care riders. For instance, like if you can't perform 2 of the 6 daily functions, you might qualify for some sort of care benefit to provide you with long-term care. Policies will give a dollar amount, sometimes a percentage of that, or accelerated death benefit if you're terminally ill to get that money to go do something fantastic before you pass away.
Excellent. So guys, any bells and whistles, you want to hear more about bells and whistles with life insurance, give us a call, 888-391-3465. It's our 2 cents signing off, guys. Have a great day. We'll see you soon.